Hello everyone, my name is Phil Seymour, Company President at IBA and ISTAT Senior Appraiser Fellow. Thanks for joining us today. Hello and welcome to our October market update. I'm pleased to welcome our experienced panel, Stuart Hatcher and Mike Yeomans, and they're also both ISTAT Senior Appraisers. The reason I'm emphasising that, the ISTAT Appraiser connection today, is because we'd really like you all to take the time to vote for us in the Airline Economics 100 Awards. We're the proud owners of the 2020 award, a year none of us will forget, but none of us will want to remember. So we'd really like to retain the award 2021. So please do vote for us, and I'll be pushing that message again later. Anyway, today the panel are going to be sharing our view of the market and see whether the end of travel restrictions is in sight, which has tended to crucify our industry. On that point, I must say our thoughts with everyone impacted by this pandemic, obviously the victims of the virus and their families, but also the broader community impacted economically, and especially those in this sector. I doubt if there are any of those joining our webinar who've not been negatively impacted by this pandemic. So as a reminder, we've designed these sessions to be around 45 or 50 minutes of opinion and analysis with some time to address your questions. Thanks to those of you who've submitted the questions already. We'll be asking more questions or be taking more questions during the webinar, so please do ping them over via the questions link on your control panel, and we'll look to address them where we can. We'll also feed in a few polling questions. So looking at the numbers, we've had around 1,500 registrants. Half of those are from the lessor and finance community, but there's a couple of hundred people from airlines. OEMs, MROs are well presented, as well as the legal and accounting professions. So a quick intro, some of you may not be familiar who we are and what we do. So we aim to maximise opportunities and minimise risk across aviation assets. We do this through our advisory services, aircraft and engine valuations and practical asset management alongside technical services. And the data intelligence is provided through our platform, IBA IQ. And here we have another slide because we're at a very important stage of that, because I'm delighted to share details of our launch of our new one-stop aviation intelligence platform, Insight IQ, which will replace the current platform, IBA IQ. We've leveraged over 30 years of commercial aircraft and engine market data, combined with the skills of more than 40 aviation and data analysts to create Insight IQ. It's a uniquely flexible platform that unites ease of use and exportability with IBA's trusted asset management and valuation methodologies to provide the trusted intelligence needed to optimize asset, portfolio and investment strategies. We'll be sharing more details of the system and how you can sign up for a demo of the new site in the coming days. Anyway, that's enough of the news of IBA. So let's get into the market update. Over to Stu Hatcher. Stu.
Cheers, Phil. Just a 1-minute economic summary because we've got a lot to get through. Oil looking bleak from the oil investors' perspective, and thankfully not much of a worry for the airline sector. Demand is certainly down, clearly, and with the GDP outlook looking bleak, the reduced airline and manufacturing demand continues to keep it down in the face of rising oil stocks. Unsurprisingly, GDP forecasts remain very depressed for 2020 and slightly rebounding in 2021, certainly for the emerging economies anyway. But further downgrades are expected if the second wave continues and progress is not made in reopening channels. Further job losses are expected in many industries still as adaptation to the situation becomes habit forming. But there hasn't been much to speak of in terms of currency movements either in recent months, which is also another thankful thing for the airlines. Although the US election result could certainly influence how the dollar responds. It has done in the past. Airlines used to hedging on their international routes naturally is diminished on the currency side, as airlines trade almost exclusively in local currencies at the moment, which will certainly impact operators based not outside of the US. So that's certainly one to consider for maintenance costs and leasing costs as well. And on the banking policy side, that remains very flat with little movement expected in the medium term. Central banks are trying to avoid stagnation as inflation remains well below the target 2%. So some processes of how they're judging and how they're measuring that have changed as a result. And certainly quantitative easing persists to stabilize the bonds. So enough with that, and let's move over to the next slide, please. So the Q3 results are starting to trickle in. I'm not going to go through these line by line. And whilst clearly not good, there is certainly more an upbeat signal of change and adapting to a permanent shift in how operators are running their businesses. Airlines across the board have managed to massively cut costs through capacity cut, retrenchment on their routes, accelerated retirements, lease structurings, furloughs, and of course, there's been quite a number of job losses and pay reviews. Revenues for those reported so far are considerably better than Q2, and load factors were up over the summer, although certainly we have seen the capacity influence that early on, but obviously capacity overall was clearly down. US markets reporting capacity down by 40 to 70% year over year, revenue down 50 to 75%. Operating costs only really down 40 to 50%. Now, of course, that's a huge factor, and fixed costs are obviously the main area that they're trying to target. Mexico, interesting, a little bit tighter. Certainly where we've seen Aeromexico reducing their fleet, letting some of the others come in. European long-haul operations remain bad though, and the capacity rises over the summer certainly exceeding that demand, as already mentioned. Refocus. Now, clearly, all airlines so far have had to adjust, but they've so far in the Q3 results and in the text so far, acceptance of this situation is there as no longer being a short term, so certainly not a V shape, and all are refocusing on key strengths and markets and retrenching to those. So the family and leisure markets rather than business, and this is certainly something all the US carriers are currently focused on, and also we've seen focusing from others as well in their earning reports for Q3. Now, clearly the quarantine yo-yo activity remains particularly destructive, no matter how attractive the offers are on trying to get travelers to fly. Although 2021 future bookings in the summer are apparently looking very strong. So there is, there's certainly some of the offers that are out there that you can book for next year with cancellation rights as well. So certainly that's going to certainly help cash the situation as well. Travel corridors certainly help, but travelers remain very cautious because they know that those corridors could close at short notice. Clearly, further aid discussions will be required. Certainly we've seen a lot of the US pandering towards more towards that. Within Europe, there's been a bit of an imbalance in terms of the government aid, but there's still some more to go on there, and the same for the rest of the world. But certainly, demand is still unable to get airlines back in black until those costs are reduced even further, and restrictions are removed. That has to be consistent for travelers to really book in larger numbers. I mean, the vaccine process is going reasonably well with more than 200 candidates in development, but certainly from the immunity levels that they're spotting are dropping very quickly. So, in terms of the herd immunity is something that is considered a factor that's not going to necessarily help. So we could certainly end up with a vaccination process that falls in line with the current flu process, but it does remain a slow process because effectively you've got to immunize, then infect, and then you've got to see the results. So it's not something that happens overnight. Fast airport testing is really something that could be a game changer, and there's certainly something in there that we need that to have that level of fast response, but there's a lot of negative press around that, and we need to cut through that with the preciseness of how that's going to help. Certainly it could help certainly within, say, the US market and certainly within the European markets as well, but that would certainly help to open up more travel corridors. Certainty of being able to travel coupled with shorter quarantine periods clearly is something that that will allow some growth even without a vaccine in place. We can't necessarily pin all of our hopes just on just the vaccine, with their processes in place as well. There certainly remains a high expectation of pent-up demand from the leisure market, which could see some strong performances based on limited capacity that we currently have in the system. But business rebounds will certainly require corporate acceptance though. Access to liquidity continues for many. Certainly there are many novel ways that people are raising cash. and to help them through the processes aside from the restructuring. And so coupled with operational improvements, that could certainly help. But there are certainly, an artificial stability, something could postpone failures to 2021. So we may not see, we may see that sort of hold back of failure for the current year, or we may see some big failures next year. And we are starting to see more partnerships growing as well. Consolidation is unlikely, but we are seeing some partnerships growing. Now, according to IATA, from presentation on Tuesday that Brian Pierce gave, the unit costs must drop by another 30% in order for airlines to break even, based on the 2020 average. Fixed costs in particular require further attention, whilst capacity has been cut significantly. Leases are being restructured, retirements are underway, and deliveries are being postponed. But it isn't enough, as the greatest effect will be seen from addressing the labour cost by potentially up to 40% in order to bring productivity in line with the long-term trend. And naturally, a reduction in capacity will highlight areas where labour can be reduced a little bit simpler, but airlines have been planning for a faster recovery to date, and to be able to react when that happens. And clearly that means that labour has been quite late on the agenda. As we move towards the middle of the fourth quarter, though, a sudden bounce back is highly unlikely, and further action is certainly required. Addressing other issues of fixed costs, as already mentioned, will have effectively too small of an effect on their own, so something more drastic. Now, I believe over to Phil for a polling question.
Yeah, thanks, Stu. So against that backdrop of IATA saying that costs have got to reduce, I think there was a comment in that report that leasing and finance costs overall have only dropped by 10%. So I know some of you will be possibly in a much worse position than 10% down. So this is really looking to see what you're seeing and hearing. Do you expect to see continued payment holidays for most airlines, power by the hour type agreements for most airlines, a combination of the above, or no more forbearance? Do you think it's just a case of time is up? So whichever one of those you think is the most likely, it'd be good to see your votes on that in the next few seconds, please. And yeah, well, I suppose it was some kind of leading question that we're going to see a combination of these holidays and power by the hour agreements. I suppose there could be a view that enough is enough, and if payments aren't being made, then the equipment has to come back. Incidentally, we did put a note out about power by the hour. We were getting quite a few questions from some investors and funds as to exactly what that meant and what the origins were. So we had put a little paper out on power by the hour. So back to you, Stu. Thanks for that. Okay,
next slide, please. So to briefly touch on the regional view, I won't go into these too heavily detail. Capacity withdrawal has clearly been significant. North America, armed with a significant government backing, has highlighted significant retirement schedules, refocusing on the VFR market, the visitors, friends and relatives market. Mexico, in that same vein, has seen some minor green shoots as Aeromexico's retrenchment has opened up some routes for Volaris and Viva Aerobus. So we have seen where we've seen some slot openings for some of those, whilst Interjet continues to have big problems. Now, interestingly, with Mexico, it still remains quite strong as a leisure market for the US, particularly certainly Cancun, and there has been some push down towards that region, certainly from the US. South America, though, has significantly felt the effect of the virus more than many others, and where we have seen also significant Chapter 11 activity. Some signs of domestic growth, but the government aid there remains particularly lacking, and they're up against significant headwinds. As we move further around to anti-clock in Africa, oil-producing countries such as Nigeria certainly feeling the strain, and there's been lots of local unrest there. However, whilst we're also seeing with South African government looking to rebuild South African Airlines as well. So we didn't necessarily think it was going to completely go away, losing that national identity there. But we're hotly looking to see what they're going to be doing there, because clearly one area for South African is that they're going to need wide body. Realistically, I mean, considering where they're geographically located. Moving towards the Middle East, naturally more geared towards larger wide bodies. Naturally, capacity drops have been heavy as they continue to overgauge their needs. And here, the 777X is not really going to be a great help either. So a fleet rethink for the whole region can't really come soon enough, really. I mean, there are certainly A380s that are still being used, very low numbers, of course, on some interesting routes, and that there's a large number there. When you consider that Emirates, of course, have got a very concentrated fleet between 777s and 380s, then certainly a smaller gauge wide body is something they need, and they need it relatively quickly. With fuel being so low too, there is little need for the travellers wishing to travel between east and west, except of course if you happen to be stopping off in the region for a holiday. So the stop midway is naturally going to be strained because fares remain so low. So moving up to the top right, within Europe, government aid has also been unbalanced there, with significant injections into Air France, KLM and Lufthansa, whilst the others have tended to secure smaller loans. And there are some big variances there in terms of the amounts that have been injected in. Clearly a region that's been more dominated by international traffic, but it urgently requires airport rapid testing and a wider travel corridor, because that's one thing where there are lots of areas where we could see some resurgence of international demand between the smaller countries. The Asia Pacific region, of course, is vast, and if we include China, makes the figures look considerably better, and I will touch on this in the next couple of slides. But once they are stripped out, the demand for the international traffic has been heavily affected, and wide body usage is certainly a key thing in that area. Operators such as Cathay in Singapore that rely solely on international traffic certainly feeling more isolated. And finally, on this one, within Australasia, separated from Asia Pac in this case, has seen almost eradication of the virus in some parts and then sudden outbreaks in others, leading to region by region restrictions. Travel between New Zealand and Australia is back up, although a little one-sided because you've got to quarantine when you get back into New Zealand. But we are seeing some outbreaks in Australia. So we would have expected a greater rebound of domestic travel to occur within Australia, but state-by-state restrictions have curtailed that. Unlike much of the rest of the world, though, their summer is only just coming, so we are hoping to see some positive movements soon as we approach the end of the year. So next slide, please. So going back, looking at the recent failures and administration cases, most of you have seen this chart already, but just to recap for those that haven't, we measure here the number of airline failures, or those going into administration in orange, and the number of aircraft involved in red, overlaid with Brent pricing. And we're looking here just at the the aircraft greater than 25 seats. We're not looking at all the smaller aircraft because the number of failures there are considerably higher. And the chart principally identifies where cost headwinds, traditionally a factor of volatile oil pricing and more recently currency in 2019, relate to airline failures. For 2020, it's been down to exposure to fixed costs and therefore comes down to survival using cash reserves, payment holidays, government aid, etc., until the market starts moving again. As the crisis persists, then the ability to pay anything back becomes more remote, and so administration offers a way through that restructuring. So I'll move on to the next slide, please, and then we can see where we currently sit for the end of October. There hasn't been a lot of change. It has been relatively flat since I would say since June, and the Northern Hemisphere has certainly been keeping that going. And the ones that have added, Cathay Dragon and AirAsia Japan, making up the most recent of the casualties. We do expect more failures as lifelines between now and the end of Q1 next year, as cash reserves are depleted. But certainly much of the pain we saw earlier on in 2020. Clearly, initial bailout packages will be running dry now, as our payment holidays, such as lessors, will have to continue to make those difficult decisions on how to react to requests. But certainly for those who we believe there is a growth opportunity, and they are changing their business models. We could certainly see quite a strong resurgence of airline activity next year, as well as, of course, a couple that may fall by the wayside. As already mentioned, labour costs really need to come down. We've heard numbers of 40% to address that situation. Certainly something more challenging for operators to deal with compared to simply capacity reductions and raising finance. So next slide, please. So the final area I'm going to go to is going through, handing over to Mike, looks briefly at some of the utilization trends that occurred over the past 12 months. So that leads up to the beginning of the crisis in China, and then how that's spread across the world, which are taken from our new platform, Insight IQ, which launches this month. I could go into any level of details in terms of specific routes, operators, aircraft types, ownership types, etc., but I'll keep it just high level for now. In the first chart, we can see the variance of total passenger flights over the last 12 months, which did experience some resurgence as we approached the Northern Hemisphere summer, and new cases reduced. Many people managed to get a summer holiday, although the inability to predict whether restriction would come into effect hampered any real resurgence, certainly globally, but certainly within Europe as well. Now, clearly this chart doesn't factor in load factors either, which shifted from sort of high 80s from the left of the chart to the sort of mid 50s towards the right on average at the height of August. And cargo traffic, on the other hand, remains firm, albeit the number of flights is a magnitude lower than for the passenger market. Now, I believe we're over to another polling question.
Yeah. On that note, so the question for you all is, which is more likely? The uptick in the freighter demand will, first one, continue due to lack of belly freight capacity in passenger aircraft. Second one, will continue beyond a return to the new normal, or will not continue once utilization returns to 2019 levels. So let's see what the consensus is on this question. Thank you. Well, as we can see, I suppose the one with the highest votes marginally is will not continue once utilization returns, because I suppose there is that view that the lack of passenger aircraft belly space is causing a lot of the demand for the freighters. However, there's not a vast majority there, and I think there is a strong demand, but I think we're going to be touching on some of the P2F situation. We've had quite a few questions on that, so I'll save those to the questions at the end. But let's get back into the main deck. Thank you,
Okay,
Stu.
so next slide. Hard to imagine, but there are two markets that have exhibited some growth from the capacity point of view, particularly domestic China and Russia, and with Russia also exhibiting positive RPKs too, 3.8%, and load factors in the 80s. Surprise, surprise. Despite China's capacity exceeding that from the start of the year, RPKs were still nearly 20% down, but certainly it's encouraging. However, on the right, I've highlighted it out specifically. When looking at the Asia Pac region and we exclude China, the rest of the region looks particularly bleak. Clearly, with very little international traffic contributing to the result, load factors are still very, very low. It's one of the largest capacity reductions in the world at the moment. So moving to the next slide, please. Moving to the slower recovery regions, and I've chosen here North America, Europe, and Asia Pac, including China. And whilst the flight mix there is starkly different for Europe compared to the others, capacity has managed to reach about 50% of the January levels, although we've got to mention, of course, that load factors being particularly low still only really around that 50–60%. So RPKs are therefore close to 70% down. Within Europe, many people, like I say, managed to get away for the summer, although plenty of traffic occurred between the UK, Germany, Spain, Italy, France, and Greece, and there were varying variances between the quarantine rules between those countries, and certainly, the UK was up and down like a yo-yo in that sense, whilst Greece was fairly open from that point of view. Without those sort of changes, we could have seen a much better result. Certainly, the pent-up demand within the UK, for instance, was particularly strong to get out too. So moving to the next slide, over to the slower movers. The impact of the virus in Latin America, the Middle East, Africa has been particularly hard. Domestic movements have led the way proportionally, but there have been very few sudden movements as we've seen in some of the other regions. Compared to the other two, the Middle East generally has the backing of the governments as well, but low oil pricing will certainly heavily impact most of the regional economies there. So we've seen some pretty strong negative GDPs. So finally, my last two slides. So I'll take a brief look at some of the aircraft type performance. First up is a brief review of wide body capacity performance over the last 12 months. And the stark difference between international and domestic usage is quite apparent, although there is a 5 times difference between the sizes of those markets. On the international sectors, the triples, the 787s, A350s have rebounded the strongest, although it's quite hard to measure that in the noise. Whilst domestically, all of the principal types have rebounded. Clearly, this is something which we would expect to see within some parts of North America and certainly within China and Japan as well. But and aside from the almost total loss of A380 flights, the A330 as well, we saw the largest relative drop in usage during the middle of the crisis as well. But clearly, when we look at the domestic side, the A330s have been rebounding in terms of domestic use. So there's certainly a need for the use of that aircraft. And on to the next slide, finally just looking briefly at the narrow body market and the 6 most used types. Overall, global capacity levels have exceeded the 50% point, which is encouraging. Obviously dominated by the 320ceo and the 737s. But on the right-hand side, when we look at just the latest generation of these, the A220s and the NEOs, we have seen a global, a larger recovery, albeit at a much lower level fleet size. But certainly better than what we've expected, which is something we'd have expected, and it's certainly a stark difference between other types. Now over to you, Mike.
Thanks very much, Steve. So I wanted to start by talking about the OEM situation and what's happening in terms of deliveries. So they put a chart up here so you can see sort of in a historical context versus recent years how many deliveries have occurred year to date. As you can see, no surprises, a significant reduction there. We've delivered around 560 aircraft through to today, and expecting, based on the sort of last couple of months numbers of deliveries, we should get to around 700, maybe just over 700 deliveries by the end of the year, which, despite the MAX not delivering last year, is only going to be around half of the number of deliveries that we saw in 2019. That said, it is around 100 more than we were expecting in our July update. We were expecting to see only around 600, so we have seen an uptick in delivery since the sort of depths of the crisis, and as we were starting to come out of the global lockdowns. If you look at the proportion of deliveries by aircraft class, which is how we've illustrated it on the chart there, it's very similar to what you've seen in previous years, so sort of high 50s, low 60% of deliveries into the narrow body market. And if you look at the OEM sort of spread within that, this year it's been around 68% of deliveries have been Airbus deliveries, around 19% Boeing, and then the remainder split between the other manufacturers, sort of 2, 3, 4% shares each within that. I'd say that there is, despite the significant decline in the number of deliveries, still some risk of overproduction. If you look at the aircraft that were delivered between March and the end of September, around 15% plus of those are not actually active at the end of September. I think if we're obviously going to see the MAX coming back online soon, with it starting to become more apparent that the aircraft is returning, and we might see some aircraft come back by the end of the year. but given that and the impact on demand, I think if we don't see a return in traffic quickly, then we will need to see further rate cuts going into next year as the MAX comes back online. And speaking of the MAX, I think we can move to the next slide. We do have some information around the return of the aircraft. So recent news that the aircraft should be back flying expected by the end of this year, but realistically, in our view, a more meaningful return in terms of numbers of aircraft is likely to be in the second quarter. It's going to take time for the aircraft that have been built and that are stored to have the necessary modifications put into place. Any sort of training and regulatory considerations will need to be addressed before we can see a large number of aircraft coming back into the market. So looking at that number of aircraft is around 800. That's between aircraft that have been built, delivered, and obviously stored due to the grounding, and aircraft that have been built by Boeing but have yet to be delivered to their relevant customers. As there's around 385 that are in storage and 413 built and yet to be delivered. Now, see, these are going to a wide range of global customers, and we're not expecting certification to be uniform across all world regions, as the aircraft comes back online. So naturally, the FAA is going to certify first. It sounds like EASA will certify soon after that, but the Chinese authority, so the CAAC, we're expecting that maybe takes a little bit longer for them to certify the aircraft. So we've shown on the chart here the countries by customer where the stored aircraft and the built but not delivered aircraft are. So you can see United States, over 200 aircraft, but also China. So we've heard the recent news. Originally, Boeing was saying that they plan to deliver close to 450 aircraft during next year. That's now been revised, so half of the aircraft are likely to come back next year, and then the other half in the following year. And we'll naturally see, I think, through next year, the number of aircraft delivered from production increase as Boeing starts to bring the production back online. But it certainly is going to take some time for those aircraft to come back into the market. If we move on to the next slide, please. We just wanted to touch on, we've had a lot of questions from our clients and feeding in from the audience before the webinar on how we're going to approach values of the MAX. Have we made changes? What's that going to look like as the aircraft come back online? First point we wanted to make is that we've not adjusted our base values for the MAX really since the MAX originally entered service. There's still a significant backlog and sufficient to support a liquid secondary market trading environment, and that's really central to our base value opinion. So we've not made any adjustments to that. We're showing on the center of the screen there our projection, our MAX base value retention for a July 2020 delivery aircraft. We've also, for illustrative purposes, given the current soft market conditions, our soft value view. And you can see on the right hand side our current MAX 8 values across all of the vintages of the aircraft. And you can see while market values are naturally below base, they are still holding slightly above soft. We'll obviously be watching that situation closely as the MAX comes back into service over the coming months. There's also been a lot of questions around aircraft that have been built and not delivered. Which vintage are they? How will they be treated? How will the market perceive those? So we will be incorporating a penalty adjustment for aircraft that have been grounded for the long period, have been sort of in storage and not delivered. We do see a sort of market perception on those aircraft, and that there would be a difference to an aircraft that has been built and subsequently delivered, no matter weeks or months. So we'd still consider the vintage to be the vintage of delivery, but there will be an adjustment to reflect that, and that's likely to be a short-term adjustment and not something that will last years into the program. We may have to look though that's on a more generic basis, we may have to look and take a more sort of nuanced approach on specific aircraft, looking at where they've been stored, what's the length of time that they've been stored, and what maintenance has been zeroed. Have the maintenance clocks been zeroed on the aircraft? Does that apply to all maintenance, calendar items included, etc.? So, there are some specific considerations that we might have to make on a tail-by-tail basis. We can move to the next slide. We've sort of looked at some of the newer end of the market, the delivery situation with the OEMs, and obviously the return of the MAX. We wanted to look now at some of the older aircraft in the fleet and what's been happening there. So this is a slide we presented in the previous market update on the fleet exits. So this includes publicly announced airline fleet divestments, retirements, early lease returns. We've also factored into here rejections from Chapter 11 bankruptcy protection, and we've identified over 1,500 aircraft that are exiting the fleet, or have some already have exited the fleet since the advent of COVID. The time frame for these exits reaches out largely to 2024, but I would say that is heavily weighted towards the near term. So many have been 2020. There's a large number in 2021 as well. There aircraft types that have exited almost immediately, aircraft like the 747, and we've seen a large number of A380s withdrawn as well there. And some aircraft types have had a significant impact on the global fleet, to the extent that the MD-80-90 family has pretty much been wiped out by COVID. A large portion of the 717 fleet as well has been affected. A340s been viciously affected, so is the A380. And even the liquid narrow-body types, the A320, 737 NG family, you can see significant numbers there that are leaving the fleets, but obviously they're much larger fleet sizes. One of the types that I would point out on the chart here is the 777. That these are all the aircraft families. So within that you have the 200ER, the 300 and the 300ER. But the 300ER does feature quite heavily within those numbers. There's around 125 777-300ERs that will be exiting the fleet over the coming years. Likewise, you can see on the chart there, the A330s, we've seen a significant number of aircraft coming out there, an aircraft that was already facing pressure before COVID, and the additional aircraft entering the market will add further to that oversupply. If we can move on to the next chart, please, we're going to have a look at the age profiles of these aircraft. As we mentioned, MD-80s, 90s, 747s, among the older members there. I think if you look at the what's going to happen to these aircraft, of the 1,500, around 700 are going to face retirement and probably won't re-enter service. When you look more to the top end of the chart here, that's where you're expecting to see more vulnerability of aircraft not coming back. So we know the MD-80s, MD-90s, those aircraft won't return back to service. If you look at the general average age of the retiring aircraft, it's around 20 years. That's about almost half of the aircraft at about that 20 years old. You will, though, if you look on the right-hand side of the screen there at the pie chart, see that there are some younger aircraft that will face retirement, some of which even in the 6 to 10 year category. Those aircraft are likely to be among the types of A380, A340s, 777-200LRs. Those are types that have really been punished by COVID and are unlikely to recover. So if we can move to the next slide, please. We're continuing on the topic of aircraft retirements and fleet exits. There's obviously a large number of aircraft parked at the moment, some of which have been featured in the analysis on the previous slides. We just wanted to look at some of those larger parked fleets of sort of midlife, 12 years or older aircraft across the narrow body and wide body segments, and to really look at which aircraft are more vulnerable not returning to service. So I've used a sort of RAG, red, amber, green color code here. So green means that we would expect most of those stored aircraft to return to service. Amber means that not all of those will be retired, but a significant proportion will return to service. But red means that's where we would be concerned about more aircraft not coming back into passenger service. So you can see it's not a huge amount of green on the chart. There is obviously a balancing of supply with demand that was going to be occurring over the coming year. We start with the narrow bodies. A320, 200, 737, 800. Certainly some of those older aircraft are going to return to service, but we are seeing sounds around some of those aircraft retiring and not coming back into the market. Certainly the 737, 800, there's options for P2F. There's A320 options there as well, so we may see some aircraft converted. The A319 and 737, 700. Those have suffered from some fleet exits in terms of the 319. The 700 fleet's heavily concentrated in Southwest, so we can see some vulnerability there as the MAX comes back into service. Some of those older types are where we'd have some more concern. So the 75s, although we might see some freight conversions, the older classics in passenger form, those that are not suitable for freight conversion will certainly suffer and unlikely to return. 321-200 is probably the aircraft we'd be most positive on the chart there, given that it's a smaller number of aircraft stored. We know that there's been some repossessions and it's not operator fleet retirements. There's going to be an ongoing demand for freight conversion, so that's one of the types we'd expect most of those aircraft to come back. When we look at the wide body aircraft, it's a bit of a bleaker picture perhaps. Some of the 777-200ER, we'd see those as being at risk. Obviously, we've identified the 747-400. There's about 130 aircraft that are in storage. There's only about 15 that are active at the moment, and we'd be very surprised to see many of those aircraft coming back into service. Some of the sort of mid-sized wide body 767-300ER, still a popular aircraft for freight conversion, so we can see some of those going into conversion, but we are aware that a large portion of that stored fleet is somewhat older, so therefore may not be as suitable to convert as some of those younger aircraft. The 330s, 200s and 300s, are those as significant oversupply at the moment. We would expect to see some of those aircraft coming back into service over the coming years as demand recovers. There's also a passenger to freighter program for those, so we might see some conversions there. When you look on the right hand side of the chart though, 340, 300s, 340, 600s, little chance for those aircraft, and some of those older 777s would fall into that camp as well. So if we can move on to the next chart, we just wanted to explore a little bit in terms of what's been happening with trading over recent months and through COVID. So you can see in terms of sales and sale and leasebacks, we are seeing the number of transactions gradually picking up. It's generally following the trend that we've seen through COVID. The number of sale and leaseback transactions is one area of the market that has been, we would say, more active, particularly notable given the reduction in the number of new aircraft deliveries, which would have been financed through that channel. So there has been an uptick in the number of sort of new or nearly new aircraft with some of those better tier credits through the sort of COVID period. One area of the market though that has really flatlined, that you can see with on the right hand side of the chart, the dark line, since COVID has arisen. We haven't seen any new ABS transactions really coming into the forefront. We have, however, seen some EETC issuance from some of the stronger carriers there. I think if we can move on to the final slide, I think it's the final slide.
Actually, we've got a quick comment question.
Oh, sorry.
That's okay. We'll slip this in fairly quickly. So in terms of scheduled deliveries for 2021 in general, are they being accelerated to as soon as possible by the airlines, being delayed by lessors due to the payment holidays given in 2020, being converted to PBH? Don't be scared, there's not a wrong or right answer to this. We're just looking for the general consensus. So look forward to your response on this one. And yeah, I think moving things to the right is very much the wish by the lessors, because you don't really want to have equipment back right now. Meanwhile, of course, some airlines just need to offload some of that capacity. And again, we have the PBH option. So thanks for that, and we'll get back onto the deck, Mike, as we are running short of time. Thanks.
Okay, thanks, Phil. I won't take too long on this last slide then. We just wanted to wrap up with some of the thoughts around values and lease rates, and what changes you're likely to see in our next value update, which is going to be going live in January. From the commentary that you've heard in the previous slide, it's no surprise that values are under pressure, and that covers most types. And we have made downward adjustments already for most aircraft types due to COVID. I think if you look at what's happened in recent months, you're likely to see some more downward revisions for A330s. We're expecting to see more aircraft coming off lease over the coming years. Other than the domestic markets, the sort of return in terms of utilization and storage has not been great. The 200 as well, there's still large numbers of aircraft stored there. I think the 777-300ER, we've seen numerous fleet exit announcements. You know, there's large numbers of aircraft coming out in terms of the next year or so, or going into storage, and the utilization recovery has not been too great. So we might be making some downgrades to values there. In the regional market, the E190, we have seen some low sort of transaction data points over recent months. Some of those have been distressed in some cases, but we are looking at potential downgrades to the aircraft there, not to the level of the distressed transactions that we've seen, but certainly some softening evident in the market. If we look at the narrow bodies, the newer generation, we're expecting to see minimal changes in the January update, really, based on our current position. We are going into a couple of difficult months for airlines, so if we see additional supply coming from airline failures, we might have to rethink that. I think if you look at the current generation, we'll see a similar situation, really. If we see marked increases in availability through airline failures and additional aircraft coming out, then we'll have to make some adjustments there. Looking at the turboprop market, we have seen some softening in values there. Some of the data points that we've seen could lead us towards some further downgrades in terms of values and lease rates. It's one of the types we're expecting to see making a bit of a stronger comeback. That's not been particularly evident at this stage. So there might be some further downgrades there in the January updates. I would caution that any aircraft types that are in with struggling carriers should be watched closely. You know, those types could be exposed in the event of failure, and that will lead us to make downward adjustments to values commensurately. So that's one to watch out for over the coming months as some of those airlines face pressure. If you look at our lease rate opinions, generally I think you're going to see some downgrades. There are some challenges in the current market conditions with ascribing a long-term fixed lease rate opinion, because power by the hour is so prevalent and seems to be the starting point for most negotiations on leases, and I don't think we're going to see that changing over the next few months. So with that sort of backdrop in mind, I think you're going to see some downgrades to our lease rate opinions as well. And with that, I think pass over to Phil, who's going to wrap up and move to questions. I can't hear you, Phil.
Thanks, Stu and Mike. I'll give you a couple of minutes to rest before I throw the questions at you. So while you're getting your breath back, the key takeaways, clearly there's continued distress amongst the airlines. There's some positive hopes around a testing solution, although there does seem to be quite fragmented, different airports and different airlines coming up with solutions. With hindsight, I think an industry-wide test would be the way to go, but we have to deal with the situation we're in now. As Stu's pointed out, there's pockets of domestic growth in China and Russia. We're getting a lot of questions around year-end impairment questions, not just for owned assets, but also IFRS 16 and the rights of use that the airlines have, and how they may need to be assessed. Wide bodies still facing pressure, and obviously there's a view that the older aircraft types will be exiting the passenger market. P2F programs appear to be in strong demand, and I actually will stick on one of those points there, and I'll put this to you, Mike, that we say the older aircraft types are likely to exit. We have had a question about whether the low fuel price will mean that older aircraft will continue in service. What do you feel about that point?
I mean, that's something an idea and concept we were toying around with earlier on in the crisis. But when you look at the decisions that the airlines seem to be making, that's not really featured. It seems to be, a flight towards newer technology aircraft, maybe some forward planning in terms of what do they want what do airlines want their fleets to look like and be focused on coming out of this pandemic, and that seems to be the newer, more fuel efficient aircraft. A lot of the research and work and conversations we've been doing around the environment will feed into that as well. I think that was a really hot topic before the pandemic, and it's certainly not gone away, certainly not from investors' perspectives. So I think that there will be, that's an important consideration for airlines when they're building their fleet plans for the coming years. So, yeah, the fuel price at the moment is low. I think as demand recovers, that will increase, and as that increases, it's certainly going to play into the hands of the newer, more fuel-efficient aircraft. So.
Yeah, and I think there is an ESG aspect to this. I think with a lot of governments supporting airlines, they're also trying to tick the green box and maybe push towards those newer technology aircraft coming in and replacing the older ones, but we'll see how that works out. But we have had lots of questions, but we're going to have to get back to you individually probably, because we are getting short of time. I think as far as one question we've had, I will be very rude and go over time, but also don't want to get complaints that we haven't picked up some of the questions. So one of these, we won't have half an hour to answer this, but it is a question that's been raised, and we've seen it from others as well. Is there an element of airlines that have younger aircraft that are less likely to have maintenance reserves in place, make it more attractive for airlines to operate rather than mid-life maintenance reserve secured leases? So I think there's a view here that if you've already saved up towards maintenance, if you've paid a lessor accruals for maintenance, that you will be wanting to, I suppose, capitalize on that reserve that you've put into the system, and you'll keep that aircraft. Would you think that's a fair view? So the way you're looking, Stu, you're thinking, well, it might depend on whether the lessor, of course, looks like I'm going to answer that question myself. I think the discussion with the lessor, that the lessor may well prefer a situation where those maintenance reserves are not spent. And it may
cash conservation.
Let's not spend money on those engine shop visits that are due and those LLP replacements. Let's just keep the cash and let's do power by the hour. Let's see, let's lease a couple of engines rather than put those engines in the shop.
But I would say it might just be a fact of the current time. So we may certainly find that you know, we expect the engine leasing market to get a significant boost now. You know, as operators start to go through all the green time and not spend any cash, then clearly the engine lessors are going to be very busy to try and fill that. I mean, there's only a limited number of engines there as well, and once those have gone out, then really there is not a lot of opportunity. You have to start spending cash. But certainly in the very short term, I'd imagine the engine leasing market is going to get a significant boost. With, you know, some lease rates are going to start to go up pretty sharply, as we've seen in the past, in you know, post downturn situations, or during that work through, and we've seen that in 2001 and likewise in 2002 and 3, and likewise in 2009 and 10, such that there are plenty of engines out there. There are some which are in quite short supply already. So certainly some of the narrow body engines will have to go through. The wide body engines, it could be a while before we even get close to trying to take some of the green time off some of those. But certainly they're the ones you've got to watch for, in terms of no lessors are not going to want to spend any money on certainly a wide body engine.
Yeah, I should just clarify, because I think I went down a slightly wrong path there. The person who asked the question is saying that actually perhaps the point is that the airline may choose to operate an aircraft that isn't paying maintenance reserves rather than one that is paying maintenance reserves.
Oh, I see, right.
It would be yeah, rather
but
than
then I mean, yeah, certainly we've not seen any specifics that would suggest leasing aircraft are being utilized less as well in those situations. We've looked at the lease and operate. Obviously we can't tell specifically which ones are reserved. We know which operators tend to have one type of lease, and you know, we would tend to find one operator has a higher concentration of reserve leases, so it's really a question of owned versus lease, whilst the better credits would have a compensation situation, and would be using the compensation itself as a negotiation.
Yeah, and we won't go down the path of non-discrimination clauses, because we definitely have run out of time. But look, thanks everyone for joining us. The slide that you've seen for the last couple of minutes is just to emphasize, and to our plea to you is to vote for IBA as Appraiser of the Year 2021. So with that in mind, I would say the last slide is really saying that all the information today has been provided by Insight IQ. It is now evolving into the real deal, and we're offering demos, so do drop us a line or register through the website if you'd like to take a look at the system. So please do get in touch if anything else we've discussed today is causing you any problems or opportunities. So thank you all for attending today's session. You will receive a follow-up email tomorrow with a link to the recording of today's session and the slide deck. So on behalf of IBA, Mike, Stu, myself, and our marketing team of Mel, Lucy, Dom, and Abby, thanks for joining us today, and goodbye. Thank you.
Thank you. Bye-bye.